What's up, guys? I'm nobody special, and I have a special guest back on the channel for the third time now. Is Mario from Mineko 64. Mario, how you doing today?
Yeah, I'm doing well, Jack, and you?
I'm doing very good. Thank you for being on. And there's been a lot of news coming out of the UK lately, so I reached out to you, boots on the ground information coming from the UK, and then woke up this morning. I know it's the afternoon for you where you are. Wanted to see what was going on in the UK today, and there's just all this news is coming out of the UK. So, very aptly timed interview today. The big story. I am going to share my screen here with you. The big story this morning, this is a tweet from Javier Blas at Bloomberg, says in another U-turn, the UK government has shortened the universal energy price cap to April of 2023. So they've gone from a 2-year energy bailout price cap, whatever you want to call it, down to 6 months. And after that date, it will be replaced with targeted support, whatever that means. And initially, the cap was set to go until October of 2024. So, what can you tell us about what's going on over in the UK with this energy situation and with these price caps?
Well, it's interesting that you bring it up because most of the talk in the last week or so, because of the collapse of the gilt market and the collapse of sterling, was on the mini budget by Kwasi Kwarteng, which he announced it on September 23rd. But a couple of weeks before, when the Truss government just came to power, they introduced this energy price cap because things were going to get really ugly this winter. Energy prices were going to rise on average to almost like £6,000 a year. So they capped it at 2,500 for the average household. At the time, the cost for this was estimated to be around 150 billion pounds. And I thought to myself, and I even I even made a video about it, that the UK chose hyperinflation with this open-ended energy program. Why open-ended? Well, because if energy prices over the next 2 years were to go through the roof again, like they did earlier this year, we wouldn't even know how much it would cost to us. So yeah, as I said, it's good that you bring this up, and it's interesting that they never talked about this energy package last week. They were blaming the mini budget, which was going to cost 45 billion. I think what they didn't like were the tax cuts because they're globalists, and they said no, this doesn't go along with the globalist control mechanism. Even though I thought Kwasi Kwarteng would have probably calmed the markets down if he had introduced his mini budget and at the same time said, look, we're going to also cut the size of government. But he didn't. That was the big mistake he made, in my opinion. So now with the new chancellor, I don't even know if he's the real chancellor. He's just like a puppet, has no experience in finance. He's been told by the money man what he needs to do, reverse everything, of course, and even the energy package. And it's not surprising to me.
You know, it never sat right with me the way the world press zeroed in on the tax cuts. When you said the mini budget, right, that was released a few weeks ago, and it included $45 billion of, and the phrase was unfunded tax cuts. And I hate that expression, by the way, unfunded tax cuts, because it kind of begins from the position of all wealth belongs to government. And if we let you keep some of it, well, we need to figure out a way to pay for that. Just don't take the money to begin
Even
with.
though it's us that pay for the taxes.
Yes. Yes. And nobody ever worries about how are we going to fund a tax increase, but how does the government fund a tax cut? And also, a lot of these tax cuts was just canceling a plan to increase the corporate tax. So, it just didn't sit right with me. And then the numbers also, we had a $45 billion in tax cuts, but that was spread out over several years. And then you had this 45 billion, or some estimates were from 60 to 150 billion for the energy, and that was supposed to be spread out over 6 months. So how does 45 billion over 2 years have more of an impact on the debt market than as much as 150 billion over 6 months. That it didn't make sense. And I think you hit the nail right on the head. It's the globalist. You had the IMF, the EU, the European Central Bank. They were all coming out in this chorus saying things like this wasn't a time for widespread or untargeted stimulus, basically bad mouthing the tax cuts. Um, but they just glossed over this infinite price glitch in the energy markets, which was, in my opinion, clearly what was driving this problem in the UK.
Yeah, definitely. And I mean, I've been talking about this for the last few years that the government is still too big. We've got government spending 50% of GDP. And what this is going to do now, because Jeremy Hunt, he's reversed everything. I think the only thing he hasn't reversed is a cut in the national insurance, which is like the social security tax. But yeah, and he said that now they're going to cut some government spending, but most of it is through what they call efficiencies. So and it's over 5 years, over the medium term, and in 5 years there won't be in power, and nothing will have been done. I've noted already that in 2010, the chancellor then Osborne, he promised the same thing. He said in the medium term by 2015 we'll have no budget deficits. And here we are, 12 years later, sorry, and we're still running huge deficits. I mean, I said this morning in my video, would you invest or lend money to a corporation that never makes a profit for over 20 years? I wouldn't. So I don't think we are out of the woods. Yeah, there's a rally here in Sterling cable, and there's a rally in gilts in the government bond market, and yields are coming down. But I don't think we are out of the woods, not just in the UK, but in the whole of the world, because I think over the long term now, yields are going to go up, not down like they have for 40 years prior to 2020. So we're going to see continuous. What we're going to see is higher highs and higher lows in bond yields over the next 30 to 35 years, I think, and it's not going to be pretty. And we're feeling that already now.
Yeah, I mean, the world is overdue for it. We've had really 50 years of progressively lower interest rates. And we'll say 40 years since the 1980s, since the end of the Paul Volcker days here in the States, interest rates have just come down and down. And so we've had this rot has sprung up in the economy. These we call them zombie companies over here, companies that don't make money. They only exist based on promises of future earnings
Yeah,
and based on access to the debt market. Well, that access to the debt market is being taken away, and so these companies are on life support
yeah.
and they're going to fail. And now that we have the inflation problem, we can't just resolve this issue the way we've always resolved it with lower rates and QE. That makes the inflation problem worse.
Yeah,
Uh,
and even governments, it's not just zombie companies, zombie governments. They've been financing everything for the last 40 years very easily, and I think the UK found the hard way in the last month or so that party is over.
yeah. Now, the way things are going in Europe as a whole, I don't want to zero in on the UK here for the energy situation. I think it will happen in the UK first because the UK has the least amount of natural gas storage of any European nation. They only have about 2% of their annual use in storage. Most of it comes from pipelines from Norway or from some UK fields in the North Sea. Um, but really, I call it Europe's economic death triangle. I see these three policies to address this energy crisis that, in my opinion, really creates a recipe for prices to infinity. And I don't think the Keynesians that are running things in Europe quite understand it. You've got price caps for the retail customer, which, for humanity reasons, obviously we don't want to bankrupt people for energy. But at the same time, if we don't let energy prices at the consumer level rise, then there will be no demand destruction and there'll be no incentive for people to use less. So we've got price caps. And then combining that, we've got bailouts coming from the government to the energy producers who are going to be operating at a massive loss now. So we've created unlimited bailouts, which means the producers will continually pay higher and higher prices for the fuel, even though they can't raise their price to the consumer. And then on top of that, you've got very little action, if any, being taken to address new supply. And so the way this price structure set up with price caps and bailouts and inaction on supply and demand will never come into agreement with each other. And through these bailouts and the QE, they've created a mechanism for infinite prices. Prices will continue to rise and they'll never stop rising because no supply will ever appear on the market and no demand will ever be destroyed. And, talks about cutting spending or, a little bit of deficit reduction, I think is really a joke at this point because as long as they're doing this, we're talking about blowout budgets the likes of which Europe has never seen. I mean, am I
Yeah.
missing something here? Or,
Well, we saw that as Germany also came up with a package, 200 billion euros for the energy. But I think there's a few things that are influencing the energy crisis in Europe. The first one in the UK was the 2008 Climate Change Act, which was passed through Parliament right at the heights of the Lehman collapse. No one really noticed it too much. And I think only 5 MPs of both sides of the aisle voted against it. And I even interviewed one of the MPs who's now a Lord, Lord Lilly, a couple of months ago. And he said that that's subsidized the alternative energy sector, subsidies that we shouldn't really be giving because they're not like businesses that would be financed in a free market. And that's hurt. That's been one of the great things that also has hurt, like fossil fuel, the normal energy supplies that we haven't put money or invested in it. It's this green agenda that we have to have net zero by 2050. And apparently we pushed Europeans, the EU, to follow that as well. It was the UK. So and the other point is the US foreign policy through NATO. The US has been preparing since 2014. This is what a US military guy said the other day on mainstream TV. They've been preparing to provoke Russia to move into the Ukraine so that they could destabilize the region and turn Ukraine into the arms of NATO. And I'm afraid to say, unfortunately, the European leaders have no backbone, maybe because US troops are still in Europe. So, who's benefiting from Europe having to follow US foreign policy? Well, the US is. So it's not just the Keynesian philosophy in Europe, but also geopolitics, I'm afraid. But yeah, you told me earlier that, and I hadn't heard of it, that EU politicians are thinking of putting a price cap on the Dutch gas futures TTF. And the first thing I said was, yeah, well, that's not going to work because when you do price caps, you create shortages and higher prices. Politicians never learn, and the TTF future has come off quite a lot from around 300 euros. I think we're around 135. But prior to 2020, it used to trade between 10 and 15 euros. So it's still really high. And I don't think this will work.
yeah, I mean, what we always say, some of these common sayings you hear on these financial channels on YouTube, the solution to shortages is higher prices. So if you ban higher prices, what you're creating is a government mandated shortage. Now, that's never politically spun that way. Price caps are always sold to the public as if, hey, we're here to help you and to keep you from going bankrupt. But what they're really saying is we're going to make sure somebody doesn't get enough gas, and then you can count on us, the government, to make that choice with your best interests in mind. And I think if you were to rephrase it that way, most people would say, "Excuse me? No, thank
Mm,
you." Right? Because they'll never run out, just like the same thing with eating bugs and banning cattle farmers, right? I don't think the people that are pushing for these policies have any intention of ever giving up one single steak dinner. They want everybody else to eat less meat. They want everybody else to use less gas. So what we're really heading for when we see headlines like this, with this, price rigging, is we're heading for government mandated shortages and therefore rationing, where the government decides who gets it and who doesn't. And, then the question is, does the government have your best interests in mind? Do they care more about you, or do they care more about the people who fund their campaigns or the people who pay their tax dollars? And, the other thing is, the solution to higher prices is higher prices, because when prices rise, you get demand destruction. So if we have a shortage, the solution to the shortage is to let the prices rise. And then the prices rising, well, that problem fixes itself. So economics, the laws of finance have a mechanism in place to address this. Unfortunately, it's very painful for a lot of people, but this interventionist policy from the government is only going to amplify the crisis. And, a friend of mine, Joe Brown, runs a channel called Heresy Financial. He says this all the time. You can never eliminate risk. You can only move it around, transfer it from one party to another. And what they're doing here is they're spreading the risk across everybody in Europe. And I
Yes, and
don't think it's
and
going to
and
do well.
the EU, the bureaucrats in Brussels, they're still 100% behind this green agenda. So they're going to push for alternatives, and it's really very expensive to bring that on board, and it's going to require more subsidies, like Lord Lilly, who I interviewed, said. And even in the U.S., President Biden brought this bill called the Inflation Reduction Act, which is anything but was actually an act, a green agenda act disguised as an Inflation Reduction Act, which is a total joke. So even in the U.S. right now, you might not have such a bad energy policy as in Europe, or a crisis as in Europe, but it could get a lot worse if they keep pushing this green agenda, and it could get a lot worse in terms of like oil, or petroleum or gasoline, as we've seen with OPEC Plus now, who want to cut. Well, they're going to cut 2 million barrels a day. And not to talk about the strategic petroleum reserves, which are going to have to be replenished probably starting next year. And that's going to drive up oil prices all around the world.
Yeah, a lot of people say here in the States, they talk about how inflation has peaked, it's starting to come down, CPI is lower. If you really look at the numbers that have made up these inflation reports for the last few months, it's all come from energy, and the energy market is fake right now. There's a million barrels per day of artificial supply is being
Yeah.
pumped into the markets to lower prices, and that is a temporary fix, and it's going away very soon. So
Yeah,
inflation,
even core CPI, which doesn't add energy, a few months ago it was at 5.6. The latest one is back above 6. So even
yeah.
and the headline CPI has come off from like 8.5 or 6 to 8.3, and that's despite the Fed raising rates aggressively. So I don't think inflation is going to come down, or prices. It and I think some people have done research that in the last 300 years, once inflation goes to 8%, it takes at least 7 years to get it back down to 2.
Wow.
So
So get
unless,
comfy, folks.
but it's always possible that they can fudge the number completely. They can take everything out of the CPI basket and measure nothing, and yeah, maybe that will bring it down.
Yeah, I was having this conversation with a Twitter feed, the Happy Hawaiian that I follow on Twitter, real smart guy, and he was kind of talking about, he was debunking the inflation has peaked myth, and we were having the conversation that all of the reductions, the only real categories that have dropped in the CPI index has been energy, which we just mentioned is fake from the SPR dumping, and autos. And autos had reached bubble proportions. The prices, because of the chip shortage, were so high. And yeah, the auto prices are coming down now. I think predominantly because people just can't afford cars anymore. They just literally can't afford them after they pay for food and fuel and rent. There's nothing left over. So I don't really think the auto inflation coming down really has anything to do with the Fed. Maybe a little bit, right? The financing of a car payment got a little bit more expensive. But I just think that's overall misery in the economy. That's not really any direct result of what the Fed is doing. So when you
Yeah.
really look at the CPI report, the Fed's rate hikes have not had any measurable effect whatsoever on inflation at all. And we're several hundred basis points into this hiking cycle, and
Yeah.
they haven't even made a dent.
I always talk about how inflation is not the CPI, that's the consequence. And what is inflation? Well, it's been decades of creation of currency and credit out of thin air through artificial interest rates and government deficit spending. The government's still spending. The Federal Reserve's still loose because their Fed funds target, is at three and a quarter, while uh, prices are rising at over 8%. So it's still costing nothing to borrow money. And that's what people forget. The same people who thought it was going to be transitory, they don't know the definition of inflation. They think CPI is inflation. So they just think, oh, if CPI comes down, it means inflation's coming down. No, I think inflation's been baked in the cake since '08. Well, probably even longer, for a longer time. The thing that we're seeing now is that it's flowing into basic necessities, to hard assets, and it's not flowing into paper assets anymore, stocks and bonds. And I think that's the kind of inflation or price rises that the general public don't like, because they feel they don't feel as wealthy. But it's going to be a big problem, I think, for the powers that be going forward.
Absolutely. So, Mario, any final words? Anything that you're seeing on the ground in the UK that maybe doesn't quite make it across the pond into the States? I know we really only hear what happens there through the filter of our own press, which is not always the most honest and forthcoming with the information. So,
Yeah.
anything we should watch for in the headlines or look out that's going on over there?
Yeah, aside from the gilt market crisis and the pension crisis we've had, look out for the real estate crisis now, because what's happening is that interest rates are rising sharply here. Not the Bank of England one, but the market rates. And that means a lot of mortgage rates are going through the roof. And that's going to make the energy crisis look like a picnic. We even have some uh, experts, like people like what's his name, Martin Lewis, who was a money saving expert, calling the government to come out with a pension bailout for the general public, pretty much like the energy uh, and COVID bailout, right? So I think that's the next thing to focus on. Real estate, or the property market, and mortgage rates in the UK.
Now, could you real quick just fill in a little bit because the mortgages are handled differently in the UK. Here in the States, we have the most common is the 30-year fixed rate mortgage, but you don't have that in the UK, do you?
Well, they have what they call a 25-year mortgage. You can set up let's say a deal with a mortgage provider. But the thing is that you don't fix the rate for 25 years. You fix it either for 2 or 5 years. Yeah, you can't fix it for 25. So last year, when people were flush with cash because uh, they got given money by the government to stay at home and do nothing, and they couldn't travel anywhere, a lot of people took on huge mortgages, and because interest rates were still, the 10-year yield was still below like 1%, believe it or not, and now we're like above 4. So they took huge mortgages. They were very low rates, and usually, and people, Americans should have said, why didn't you fix it for 30 years? Well, you can't. You can either do it for 2 or 5, and it also depends. If you do it for 5, it might cost more. So some people just thought, oh, let's do it for 2 because it's cheaper. And the philosophy here, or the mentality, and I think is the same in the US, is that they never thought interest rates could rise so quickly, because we've been told by Wall Street and the mainstream economists, people like, I'm not going to mention names, but they're saying buy bonds, wear diamonds a few months ago, and they've been proven completely wrong. Alan Greenspan was right a few years ago. He said interest rates are going to rise again. And I think this is it. Alan Greenspan was right about that.
So what you're looking at in the UK then is somebody took out a big mortgage, right? Home prices ran with all the asset price inflation caused by the monetary expansion at central banks, and they take out these big mortgages. Well, at the end of that 2 or 5 year period, which hey, we're coming up on 2 years, aren't we? That teaser rate, that initial interest rate expires, and now your home automatically refinances at a significantly higher interest rate. Well, now
That's
you
if you
can't
can
afford
get
the
a
payments.
yeah, that's if you can get a new deal as well, you see?
Right.
Recently, a lot of mortgage providers, withdrew all their deals, and if you're not a great credit, you might end up having to sell your house, and we could start seeing negative equity again. So, yeah, I think that's the next, crisis in the next 6 to 9 months.
And folks, we've seen this before. This is what happened with the subprime mortgage crisis in the US in 2008. Adjustable rate mortgages, where that teaser rate expired and the payments jumped, right? That was that scene in The Big Short with the exotic dancer when Steve
Yeah,
Carell finally realized, yep, it's a bubble, all right.
yeah.
That's it, what's about to happen in the UK over the next, I mean, it's going to start soon and carry out over the next 3 years, right? As these 2 to 5 year teaser rates
And
expire.
there's another crisis, well, not crisis, but another part of the mortgage market is people like in their middle age and they're above 40 or even 50. They refinanced maybe 5, 10 years ago and they got some really good deals. And now it's coming up to in the next, I think up until 2025 or 2027, these deals are going to expire as well. And, people in their 50s or early 60s, they're not in the beginning of their working life. And that could be another problem too, aside from the 2021 rush to buy real estate.
Wow. Scary stuff. And, I tell you, these days, they're interesting times. They're not always fun, but they're never dull. So you blink and you're going to miss something. Uh, Mario, I want to thank you very much for taking the time to talk to us. Folks, the channel is Mineko64. I'm going to put a link down in the description below. It's a fantastic channel. Talks all about precious metals, about what's going on in the UK financial system and here in the States. It's one of the original ones. I've been following you for years now, since way before I even started this channel, and I always enjoy your channel. So thank you very much for the time. And any parting words for us?
You're welcome, and thank you for inviting me. Parting words, yes, things are look very scary and all, but if you look after your budget in in a sane fashion, you should be all right, and maybe even have some great opportunities in these uncertain times.
All right. Words of wisdom from Mario from Mineko 64. All right, folks. Thanks for your time. And until next time, live small and dream big.